Hey there, everyone. Dave Keller here with Market Misbehavior. I like to do these choose your own adventure style videos sometimes where we think about 4 different potential scenarios in the S&P 500. After listening to the 4 different scenarios, reviewing the charts together, you will be able to answer the question, what may be next for the S&P 500? So when we do these videos, you're using the concept that's called probabilistic analysis. And what that is basically understanding that as much as we want to think we know what's going to happen next, none of us do. And if any expert goes on TV or writes an email and says, this is going to happen, they don't know that for sure. No one does. The best we can do as investors and as well-informed investors are make decisions based on the probabilities, right? So I was taught that the market's never about certainties, it's about probabilities, right? So you want to think about the different potential outcomes. I think it's really healthy to have an opinion, have a thesis, have a position in your portfolio, but always be thinking about what we call the alternate hypothesis, right? What are some other scenarios that could play out? And by forcing yourself to think about different potential next steps, right, but different potential future paths, you'll be better prepared when something unusual happens. That's why I always try to encourage people to think about a super bullish scenario and a super bearish scenario and some other scenarios in between. One of those you probably think is the most likely next step for the S&P, but force yourself to think about those other 3 scenarios. Really think about what would happen in those scenarios. What would the major averages do? What type of leadership themes could we expect? What's probably happening with interest rates and commodities and the US dollar? And by thinking about what those different scenarios might look like, then as time actually goes forward, you can see as the evidence evolves, which of those scenarios it's starting to look more and more similar to, and then make sure you're prepared for it. Now, the chart of the S&P 500, as we look at it, really is a representation of a market that has made new swing highs. Right, the push above 4,600 was pretty significant. November, December, coming out of the October low, was a magnificent rally. But now we stalled out here a little bit, and from mid-December to now mid-January, we're sort of in a little mini range between around 4,700 and 4,800. So in a moment, we're going to lay out those 4 different scenarios. I would encourage you to review each of them and then leave a comment below which one you think is most likely and why. Now, before we get to the charts, here's one more thing I want to tell you about. The new year is a really good time to focus on routines. What do you do every day, every week, every month to improve your situational awareness as an investor, to identify potential opportunities and also manage risk? Seeking Alpha provides a quantitative model, what they call their quant rating, and I think it's really well done. A lot of the institutional investors that I've worked with always had an alpha model, which is basically a quantitative model. It's a way of looking at the statistical measures that define healthy companies, strong companies, companies most likely to outperform going forward. Then you take all of those factors, you combine them into a model, and then you regularly run it to find companies demonstrating those same characteristics. By scanning for stocks showing strength using the quant model on Seeking Alpha, I think you have a good opportunity to identify potential opportunities that could help your portfolio going forward. If you go to marketmisbehavior.com/Seeking Alpha, you can get a great deal on their premium membership, which gives you access to their quantitative model, also all of their scanning tools, and also a lot of premium commentary as well. So go to marketmisbehavior.com/Seeking Alpha. Start off the new year with a gift to yourself, the gift of better market awareness and a better sense of the opportunities of leading companies. And now let's get back to the charts. All right, so here we're looking at my chart of the S&P 500. And as a review, as I mentioned in the introduction, we had the low here in October. We broke above 4,600. I just want to highlight a couple key levels that we're going to refer back to as we go through the different scenarios, right? 4,600 is this level right here, and that's basically the high from July. So breaking above there in December was a pretty meaningful breakout. We're right below new all-time highs. It's kind of off the viewable area here, which we're just above 48, around 48.20. So we're kind of right there. The other point to note is the gap from November of this year, November of last year. And that was when the markets gapped higher on the October CPI number that came out. It was a little lower than expected as a result. The S&P, the NASDAQ both gapped higher, and I think that price gap is an important level to watch as well. Below there, you have 4,100, which is the low from October, which, again, hopefully is not a level we're thinking about in the next 6 to 8 weeks, but it's always a possibility. Now, as a reminder, if you go back on our YouTube channel, I have a link below in the description of previous times when we've done this exercise. And I think it's always helpful to go back see what we talked about, see what scenarios actually played out. So the last time we did this one for the S&P was actually September 8th of 2023, and I saved the chart so we could refer back to it. These are the 4 arrows that I drew, and here's where we did the video there in September, and I outlined a super bullish scenario where we would break above that 4,600 level, sort of a mildly bullish scenario where we wouldn't break any further but wouldn't make much headway to the upside. A mildly bearish scenario, scenario 3, meaning we would go down and retest that 4,200 level, and then a very bearish scenario, which would take us all the way down to essentially retesting the low from March of 2023, around 3,800 or so. As you can see from the price action behind, and we were talking about basically mid-September to the end of October, pretty much matched almost perfectly that mildly bearish scenario. So scenario 3, congratulations. If you picked that one, you were spot on. But again, even if you were super bullish, hopefully by thinking about that third scenario and charting out in your head what sort of event that might be and what stocks would probably do well, what the overall risk environment would look like, what breadth and sentiment conditions would do. Hopefully that made you a little better prepared for scenario 3, which again is what actually played out. Now that we've rallied back, regained 4,600 and even more, and now gotten up to the upside objective we actually did talk about in scenario 1. It just took a couple more months than that video was talking about. Now that we're there, let's talk about the next 4 potential scenarios. Now that we're here in January, I sort of updated this chart a little bit. I gave us some room above the chart, so don't worry about this scale here. I'm just trying to give us some vertical space to outline a super bullish scenario. So here's scenario 1, which I would say that we sold off the first week in January. The second week in January really has been a V-shaped recovery right back to those previous highs around 4,800. Here's the all-time high, this black horizontal line coming from the beginning of 2022, and that's around 4,820 or so. So scenario 1 is we blow right through this, and the strength that we've seen here in the last week is just the beginning. The super bullish scenario, I would say, takes us up quite a bit higher to new all-time highs and even more. And I would say the super bullish scenario gets us above 5,000 here in the next six to 8 weeks. What's interesting is that would fight against the seasonal tendencies. The Q1 or first quarter of an election year like we're in right now usually is pretty weak. And our previous video on this channel talked a lot about the seasonality in the first quarter, a lot weaker than you might expect. And so this scenario 1 would basically mean forget the seasonality, forget what normally happens in an election year. We are bulled up and we're going higher. For that scenario to play out, you'd probably see continued leadership from names like Meta, which have already made new highs, and other leading growth names, those magnificent 7 names. Those would have to go significantly higher and just continue to break out. Semiconductors like NVIDIA, other software names like CrowdStrike and Salesforce and others that are breaking out, those would just continue to push to the upside with little to no pause, and this would just be a classic uptrend phase, very similar to like a 2021. I would say that super bullish scenario probably also involves value sectors. So sectors like industrials and materials, even energy perhaps start to recover. And even though they might not be leading higher, they'll probably appreciate in price. And I would say small caps probably do well in that first scenario as well. So scenario 1 is kind of this last week was just the beginning, and we continue to push much, much higher across the board for risk assets. Scenario 2 is the mildly bullish scenario. I have the arrow going down a little bit, but that's just to say that we hold our ground. I think the mildly bullish scenario is we don't get to new all-time highs, or if we do, not by much. And if we do get briefly above there, it's met with additional selling. I think that's the big difference between scenario 1 and scenario 2. Scenario 1 is we break to new highs, and that just encourages a lot more buying power to just accelerate the trend higher. The mildly bullish scenario, scenario 2, is as we attempt to break out, there's additional selling that comes in, or people are skeptical of further upside. There's a drying up or an exhaustion of that euphoria that has dominated the markets here in the last week or so, and really the fourth quarter of last year. And you get the sense that the rally in the fourth quarter has really stalled out. Maybe this is a bit of a double top in mid-January to late December. The markets sell off, but not by much, right? So we might go briefly to a new all-time high, but that breakout is not followed through. And instead of breaking to new highs and continuing, we break to new highs and then soften up a bit. And so scenario 2 really has us ending up in that 47 to 4,800 range, kind of below where we're at right now, and and the low from early January around 4,700. Scenario 3, the mildly bearish scenario. This is where the uptrend in the fourth quarter is really reversed. That is where the seasonal tendencies that are normal for the first quarter of an election year really play out as expected. January, February, March actually tend to be quite weak. Usually in an election year like 2024, you get a major low around March, similar to what we saw in 2023 with a major low around March. So we have that kind of feel, right? A nice bounce, but then it is met with additional selling. And scenario 3 means this bounce is most likely over. We probably don't get to new highs here soon, and instead we're coming off a little bit. What's key about scenario number 3 is we do break back below 4,600, and that's the resistance from July. That's that breakout level that we highlighted on the chart in December. So that actually comes back and does not hold. And so scenario 3 means we break below 4,600, but we very importantly remain above that price gap. And on that first chart I showed you of the S&P, we highlighted that price gap. The S&P, the QQQ, a lot of individual stocks actually have a price gap in mid-November. That's when there's that big gap higher from one session to the next. So I would say scenario 3, the mildly bearish, is we do come off a bit. We break below 4,600, but we hold 4,450. We hold this price gap. And I would argue scenario 3 probably most closely aligns with the normal seasonal tendencies for the first quarter, and would probably set us up for a magnificent March low and strength in the second, maybe even the third quarter. That brings us to scenario 4, the super bearish scenario. This is where all of the signs of strength that I alluded to in the first 3 scenarios, none of those come to pass. The rally that we've seen in the last week is more of an aberration. I would say that scenario 4, most likely a catalyst for that would be earnings season, which just is getting started, is way weaker than analysts expect. Companies are underwhelming in their results, underwhelming in their expectations looking forward, and they speculate a period of slower growth, more of a recessionary feel to the economy. And as a result, investors become a lot less optimistic and a lot less excited about bidding companies up to higher and higher valuations. In scenario 4, not only do we break below 4,600, but we continue. We don't hold that gap from mid-November, and I think that's the real differentiator of that very or super bearish scenario. I think that in 6 to 8 weeks gets us down to probably the 4,300 range, but I would basically say within 6 to 8 weeks we're between that price gap and the low from October of last year. I don't see a scenario necessarily where we break below 4,100 in the next 6 to 8 weeks. It is super possible. That's maybe the aggressively uber bearish scenario, perhaps. Scenario 5, the unspoken scenario 5, I guess would be that. But I think a much more likely sort of super bearish scenario would be kind of end up in that 4,100 to 4,400 range. That's a big give back. That's a 15 to 20% drop from current levels, and would mean really the rally in the fourth quarter is reversed and we give back a lot of those previous gains. So think about those 4 different scenarios, and which one do you think is most likely and why? Make sure you drop a comment below. Tell me which one you vote for and why you think that's the most likely scenario. And to recap, here they are in order. Scenario number 1, the very bullish scenario. We break above 4,800. We break to new all-time highs. We probably break above 5,000 in the next 6 to 8 weeks. Are bullish beyond belief, and just a nice continued upside led by those leading growth stocks, but also the broader participation remains strong. Scenario 2, the mildly bullish scenario, means we probably don't get much further. Maybe we briefly go to a new all-time high, but that breakout is not met by additional buying, but by additional selling. And so the rally that started in October of last year, propelled the markets higher in the fourth quarter, really stalls out. But we kind of hold our ground, and we end the next 6 to 8 weeks kind of between 4,600 and 4,800. The mildly bearish scenario, scenario number 3, we actually sell off and break down through 4,600. So we're back sort of in that range that we were in the third to fourth quarter of last year. 4,600 does not hold, but the price gap from the November gap high around 4,450, that does hold. And so that mildly bearish scenario, scenario number 3, means we pull off, but not a horrible end of the world kind of drop. It's more of a tactical drop, and arguably sets us up for a very good opportunity to ride market strength out of a March low. Scenario number 4, the super bearish scenario, means we sell off, and we sell off good. Not only do we drop below 4,600, we also fail to hold the price gap. We break below the 200-day moving average. We're getting down into the low 4,000s, and then within 6 to 8 weeks, we're below 4,400, probably still above 4,100, but we'll be talking about whether that October 22 low is actually going to hold in quarter 2. Again, which of those do you see as most likely and why? Make sure you drop a comment below. Give me your vote and your justification. We'll follow up with our own comments about which scenarios we see as most likely, and also keep track of these different scenarios. Down the road on this YouTube channel, we'll report back as we did today about this one and see what actually played out. Probabilistic analysis is all about stretching your thinking. I hope you found this is a helpful way of thinking about 4 potential scenarios and how your portfolio may react in each of them. For Market Misbehavior, I'm Dave Keller. Be well, stay safe, and take care.